the outlook for precious metals has really never been better. We talked about last time that silver has the potential to be a gold bull market on steroids.
Please join us for our next live stream Sunday, August 9th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, August 9th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, if you are new to this channel or you have not already done so, please do subscribe, hit the bell to be notified on new updates, and give us a thumbs up if you like what we do. We really do appreciate your support. Kevin Smith is our guest today, founder and CEO of Crescat Capital, an asset management company that capitalizes on the most compelling macro themes to grow and protect wealth. Kevin has 26 years of investment industry experience, and he is the inventor of Crescat's firm-wide global macro investment process. It's time to saddle up and silver up for Kevin Smith. Kevin, welcome to SBTV. How are you doing?
Good. Thank you, Patrick. I'm doing great.
Great. Glad you had time to be here. A lot of interesting things going on. The world has changed quite a bit, pretty drastically since we last spoke with you back in November of last year. And our notions of what is possible have been pushed beyond conventional limits. We've seen nations locked down, travel restrictions, businesses shut down, and social distancing implemented amongst many other things as this pandemic crisis unfolds. Can you share with us how 2020 has been for you, and how were your notions of what was impossible challenged by what has actually happened?
Yeah, Patrick, things have been absolutely crazy this year. And certainly going into the year, we knew that there were some major imbalances in the world, record valuations for U.S. stocks, record debt to global GDP, things that we talked about in our last video that we did together, and we said in that video that there's likely to be some type of shock that comes from outside to upset all these imbalances, and we can't possibly imagine what those shocks might be. But we knew things were setting up for perhaps a bear market, maybe a new bull market for precious metals, and that's how we were positioned. And lo and behold, we got the coronavirus. So here we are today.
Yeah, I think last time when we spoke back in November, the whole repo crisis was just starting to unfold. So I think we kind of knew something was going on there. But after an 11-year unnaturally long economic expansion, the U.S. economy is now in a recession, and expectedly so, given the massive hit to the real economy. Can you give us an overview on the state of the U.S. economy, and has the economy begun to emerge from the darkest phase of this recession, or is the worst still yet to come?
Well, there's really two economic underlying environments going on. We have this 11-year business cycle that you just mentioned that was already overheated and getting ready for a normal cyclical downturn, with record debt and record valuations, and then with the COVID-19 hitting, and we've had such a huge stimulus response to that we've still sustained these equity valuation bubbles. In fact, they've gotten even more extreme. And so there's really this underlying structural recession that is still unfolding under the scenes, and very likely to continue. That has been temporarily suspended because of all the stimulus, and we're still at record valuations. In many ways, it's no different than when we talked 6 months ago or so, and or more now, and we're at that kind of still record valuation bubble level, and with a new bear market getting ready to ignite in our view.
Okay, yeah, we'll definitely get more into that. But what do you make of the Fed creating $3 trillion in 3 months to save the economy? How much good did it do?
I think that certainly it has kept the stock market going and put money in people's pockets, much needed money. I mean, it was a big shock to put the U.S. economy and the global economy on lockdown, and the unemployment, of course, has skyrocketed, and people needed that stimulus money, but it's been somewhat like a drug for the markets. At the same time, it's something that is likely to run out for the people that have benefited from it. So, printing money is part of the problem that got us into these imbalances that we've had to begin with, because you can the monetary stimulus, you can't keep a business cycle in growth mode forever. There needs to be a rational reconciliation, a cleansing, some creative destruction to prevent this kind of zombie economy situation from developing. And unfortunately, that zombie economy is bigger than ever now.
Yeah, it's true. I've been hearing stories about the zombie economy growing. But another thing growing, do you think it's inevitable that the Fed's balance sheet will only increase, and that the only way forward for them to keep the system going is to continually inject liquidity?
Well, the problem is we have too much debt. There's over $250 trillion of global debt, and even today, the amount of U.S. Treasury issuance is even dwarfing the amount of money printing over the past month or so. And so we, unfortunately, yes, there is going to have to be more money printing. It's not going to stop, in our view, in order to be able to service all of this debt.
Yeah. Is there any realistic scenario where the Fed can normalize their balance sheet back to pre-2008 crisis levels?
Um, it's really the same issue. I don't see it being able to happen without causing a severe depression.
Yeah. With what's going on right now, is this an extension of what happened in 2008, or is this something entirely different now?
Well, in 2008, of course, we had the housing bubble here in the U.S., and the global financial crisis as the derivative products from that rippled through to create havoc. I think today the consumer is in a little bit better shape than they were in 2008, but in many ways it's similar to the issues we had in 2008 when the Fed came to the rescue, Bernanke, that time, with all the money printing, and it did reignite a bull market for precious metals, and which we saw kind of peaked out in 2010-11, with people really thinking that all the money printing back then would lead to inflation, and instead what we got was all the money printing leading to asset bubbles
Mm.
in financial asset stocks and credit. And that's kind of the environment that we're at today, which is a bigger bubble than the tech bubble in 2000, a bigger bubble than the housing bubble in 2007. It's truly a unique animal, but even more imbalances. This time around, therefore, I think that the money printing, is going to have more consequences, more positive consequences for the gold and silver markets and mining industry, but and a more sustainable bull market, for that. But we printed more than two times the amount of money that we did back in 2008 already. And if you think back then, look at how the precious metals market just took off in 9 and 10, and I think it's only the beginning here today for a similar setup.
Yeah. Kevin, with as you mentioned, all that printing going on, do you think the Fed is going to get their inflation that they've been so hard, trying to get for so long, for so hard? Do you think they're going to get it? And if they get it, do you think they'll be able to control it?
Um, well, the idea that the Fed is trying to create inflation in the first place is kind of absurd, isn't it? but they act like that's what they're trying to do, and we've seen the same thing in Europe and in Japan, where the money printing has been going on for ages to deal with the massive debt problems that they have there, and it's been unable to create inflation. So it is still a valid, concern that, this deflation versus inflation debate, and how much money printing, ultimately, will it take to create inflation. I believe, as many other central bankers have said, Bernanke himself back in the day, that a determined central bank can always create inflation. The issue is that we just have so much debt, and so you have this dynamic of the debt constraining the global economy, creating zombie entities, and then you have you have this all the money printing coming up to meet that. We could talk about reasons why it can ultimately create inflation later, but we're still at a point where we have these deflationary forces, really that are predominant right now. And ultimately, I do believe the Fed can create inflation, but we're still early in that cycle.
Okay. If the way forward is a future of higher debt levels, higher Fed balance sheets, and more money printing, the question that begs to be answered then is how can the system keep expanding trillion after trillion after trillion? I mean, what do you see as the possible end game? And given that currencies are at the root of this problem, isn't the entire world strapped in on this roller coaster of sorts and we're all headed towards a major disaster?
Well, the world economy will go on, and there is creative destruction, even with all this central bank and policy intervention at the fiscal level too. Adam Smith back in the day called it the invisible hand, and ultimately, the economy will move forward. We will get through this, but there is business cycles, and it's just that the gross amount of imbalances and extremes have just gotten so large today that we that I think we're in for some continued crazy times. But the outlook for precious metals has really never been better in our view, and this idea that there is an alternative to these overvalued asset classes, whether it's corporate credit or stocks, and that alternative is gold and silver in particular, which is incredibly cheap relative to gold today. And we talked about last time that silver, has the potential to be, a gold bull market on steroids, and you've seen that starting to happen now. But heck, silver got up to $50 an ounce, twice already. The first time back in 1980, and here we are in 2020, and silver is still hanging out in the low 20s. So I think there's some exciting times ahead.
Yeah, that was going to be one of my questions where gold is almost back to its all-time high and silver is not even half of its all-time high. Why do you think silver is lagging so much right now? Or is that rubber band still being stretched where it's finally going to let go and that silver slingshot is going to happen?
Well, I think it's just this dynamic between the asset bubbles and the financial asset classes, and this almost 10-year bear market that the precious metals industry has really gone through, especially for the mining companies and the gold and silver mining companies, particularly the juniors and the junior exploration companies, and silver is just on that tier of the spectrum yeah, yes, it has industrial commodity aspects to it as well, but gold is the real money that's owned by central banks. Silver, it used to be money. It's still, people still consider it to be money. I still consider it to be money, but it just it's kind of gotten left behind with the relative to financial assets. Number one, the whole precious metals asset class, And then, if you think that precious metals are money, gold has kind of held that premier spot. Central banks, of course, all still own gold. It's the longest running central bank reserve asset on the planet. And I think central banks are going to be buying a lot more gold here in the near future. Maybe even the U.S. Treasury will get in the game here. I think they have the potential to. Um,
Yeah.
but silver is, it lags, and yet when it gets going, it can really get going. And like I mentioned, 2008, the money printing back then, and you saw silver go from about $8 to up close to 50,
Yeah.
in just a couple of years. And that's kind of the environment that I see ahead for the next couple of years here. And it sure started off with a bang here recently, the silver market.
Yeah, it's been pretty interesting to say the least. But Kevin, where do you think we are now in the gold bull market cycle? Are the public participation and mania phases here or still to come ahead?
Uh, if you think about all the money that's invested in the stock market and relative to the size of the precious metals industry, the precious metals industry is less than 1% of the global stock market cap. You can look at things like the market cap of Apple, relative to the size of the entire precious metals mining industry, and it'll blow your socks off. We are starting from very low valuations for mining companies, for silver, for gold itself, for gold relative to the global fiat monetary base. Gold is still cheap, and we have a $2,500 plus target just based upon the amount of money that's already been printed today, and that is only going to be increasing. So I see it very early in a new secular bull market for precious metals.
Okay, and you touched on this a little bit, but how compelling is the case for precious metals mining equities at this moment?
Well, the mining industry, has been through a much longer, bear market than gold itself, and the junior mining industry in particular, and you go even deeper into the junior exploration side of the market, and that is where the real deep value and growth opportunity is today that we see here at Crescat. So there's a lot of exciting opportunity, and I can talk about why.
Okay, yeah, we'll definitely get to that. But since we're back on the topic of markets, are stock markets at heady highs today only because the markets believe that the Fed's money printer is there to support them?
Well, that's probably the biggest remaining bull case for the market, and the bulls have certainly seized on that idea. And the funny thing is that even like I alluded to earlier, the last 4 weeks or so, there's actually been more debt issued, more treasury debt in particular than money printed, and so that liquidity buffer for stocks is perhaps not as bullish as stock market proponents might want to believe. And but yeah, what are the other bull cases for stocks? I don't know, Patrick. I think it's a bubble. I think it's a true mania, and these manias typically don't end well.
Yeah, I mean, a lot of people they get the sense that the market just seems to be disconnected. There's a disconnection between fundamentals of companies listed on stock exchanges versus their share prices today. And I'm sure you and Crescat has looked at that. Are you folks seeing the same thing where there's this huge disconnect right now?
Um, yes, there is a major disconnect in stock prices today versus the global economy. Like we've talked about, there's just too much debt out there to sustain any type of robust economic growth, and just allowing companies to take on even more debt through the monetary and fiscal stimulus measures that have been allowed, are it's not translating into underlying economic growth. I mean, companies are not in a position to make new hires in any substantial way, and people are I think people are if they're not scared now, they're going to be starting to get scared pretty soon, because the stimulus money is going to be running out. I mean, I know that the U.S. government's talking about another round of stimulus right now, and there probably will be something, but that initial big PPP type stimulus checks that people have been getting, I don't think that level is going to continue, and there's going to be a reality check here coming soon that may also wear off in terms of people's speculative fervor for stocks.
Yeah. Kevin, when this stock market party ends, how much of a correction do you expect to see?
We talked about valuations being close to the 100th percentile across 8 different measures that we look at here at Crescat, and how just to get back to mean or median, that means that we could see a 50% type of correction. We started to see that unfold back in March, and you can see how quickly bear markets can get going when people get scared and people start selling. And the pendulum, doesn't always stop at the mean. Sometimes it goes further, and so I don't want to put a specific target price, but we think that we are looking for at least a 40 to 60% type of a correction in stocks, and one reason for that is indeed the precious metals industry, and we view it as an entire asset class: gold, silver, precious metals, mining stocks, and when you look at the opportunity for people to pull money out of overvalued financial assets and move it into gold and the broader asset class, you can just see how that can become a self-reinforcing cycle to make that bear market in stocks get going, and to kick off that bull market in precious metals.
Yeah, agree with you there. You've mentioned before that although the U.S. has a massive debt bubble, China today still has the biggest debt bubble. So could you give us an idea of how big that bubble is for China?
Well, China has created over $40 trillion in its banking system. It's an unprecedented amount of banking system credit expansion that is been accomplished through making more and more loans that are not being repaid. So they have an enormous non-performing loan problem, and because it's a communist, totalitarian controlled country, the government has been able to keep everything appearing to be okay and sound, at the same time as there are a lot of problems underneath the surface. And first and foremost, the trade war with the U.S. and today, COVID-19 and companies pulling their supply chains out of China. There is a geopolitical Cold War that has heated up, very recently, and that could be another one of the triggers. But we believe it's the currency itself, the Chinese currency, that is overvalued, and with the capital outflow pressure that they have there from their own people, the people who have the money, who have been trying to get it out, who have been getting it out for years, and are not likely to be putting it back in if they have gotten it out, and all the capital inflows that have come into China over the years, of companies and countries investing in China. We think that those are coming to grinding to a halt as well, and so you have this big credit bubble, housing bubble in China, and no way for people to get their money out, no desire for money to come in. It's a massively overvalued currency, and at the same time, you have a current account problem that is only starting to get worse. So all these factors combined lead us to believe there is going to be a big devaluation of the yuan coming, and potentially also depegging of the Hong Kong dollar. So we do see these things as part of our future.
Yeah. I mean, if we compare the economies of the U.S. and China, U.S. is a net debtor while China is a net creditor. And China had a trade surplus of about 420 billion in 2019, while the U.S. had a trade deficit of little over 615 billion or so. China has been known to be increasing its gold reserves for many, many years, while the same could not be ascertained for the U.S. My question is, when the debt bubble bursts for China, would them being a net creditor country and they have a sizable amount of gold reserves, would this alleviate the situation or would it not matter given the size of the bubble?
Well, when you look at China as a net creditor economy with their 3 trillion of foreign reserves, you have to compare that to the overall size of their domestic credit system, which we've talked about. It's over 50 trillion actually when you look at the shadow banking and the corporate credit outside the shadow credit outside the banking system. And then you look at the 3 trillion of foreign reserves, and you have to ask yourself, are these foreign reserves really good in the sense of or like we believe, has China been using these reserves as collateral to help support their currency in the foreign currency markets and to keep a currency pegged or managed? A country, when people want to sell its currency and buy dollars, for instance, the central bank and in China's case the state, SAFE, their foreign exchange entity, they need to go in the market and buy. They need to buy the local currency and sell the foreign currency in order to keep that currency managed. So that is what's been going on in China and certainly in Hong Kong with the peg there for almost 40 years. And so these foreign reserves that appear to be on the balance sheets of these countries are that's the collateral that these countries have to go with to the large global banks in order to secure their foreign exchange transactions to keep these currencies managed or pegged. And so that's the problem is that at some point there is a margin call, a collateral call. And what is the true size of the swaps and derivatives trades that SAFE, for instance, has on its books? We don't know because they don't disclose it, and yet we think it is probably something that dwarfs the amount of these foreign reserves. And then your second point about gold reserves and China buying gold reserves. Look at the size of the gold reserves of the U.S. Treasury, and China is pales in comparison. So we think that sure, China's been a net buyer, Russia's been a net buyer of gold, of course, but the big elephant in the room is that has the potential to come in and be a real buyer is the U.S.
Yeah. Okay. If the well, let's say if the Chinese economy does go down, can we expect it to take the economies of most countries down with it? I mean, I would imagine import demand for raw materials for a myriad of goods would plummet.
Yeah, like we saw in 2015 with that first leg of the devaluation of the yuan. China has a lot of links to other emerging markets and commodity producing countries, and we are, while we're very bullish on gold, we're not as bullish for industrial commodities today. So things like iron ore and even oil. So China being the largest consumer of oil in the world too. So we think that absolutely it is a bearish fundamental backdrop for the global economy. China's been over 60% of global GDP growth in the last business cycle, and that just cannot continue.
Yeah. Okay. You mentioned deflation. You mentioned bear market. What are you looking at, or what are you seeing that is making you use these words where a bear market is set to come, and we're still in a deflationary mode, not necessarily an inflationary mode?
The problem is the asset bubbles, and we have financial asset bubbles in stocks, in corporate credit. They have been allowed by the central bank policies to be created, and this idea that we have to prevent recessions at all costs is just not it's an impossible task, and so when your only tool is a hammer, everything looks like a nail, and but the consequences, today are that we have valuations for equities that among tech stocks and growth oriented stocks, many of which are technology oriented, we have record valuations. I mean, software stocks at 30, 40, 50, in some cases 100 times sales. But it's not just the tech sector and the FANG stocks of the world that are fully valued or insanely overvalued. It's also the industrial sector and the retail sector, the consumer, consumer discretionary, and the entire stock market. I mean, even things like utility stocks are massively overvalued, and so when you have this everything valuation bubble, there is there are consequences. We saw it in 1929 with the stock market bubble back then. We saw it in 2000 with the tech bubble. Bubbles lead to busts, and they're just not sustainable. But like we said, there is an alternative to investing in these overvalued asset classes, and when people start to realize that alternative is precious metals, because that actually has low valuations and growth potential in terms of the mining industry. I mean, I think the light bulb will go on, and people will start to rotate out of these asset classes. So it can be self-reinforcing. It just needs to get going.
Yeah, I think people are going to start to pile in as well. But Kevin, given the mining companies, like other companies, they rely on energy prices, supply chains for materials, jurisdictional regulations. When the global debt bubble does burst, would stocks of gold and silver miners implode with the rest of the market as market participants panic and rush from the exit where they may feel, just get me out of the market completely?
Well, that's a good question. We look just to what happened back in March when we had that first big down leg in stocks, and you saw gold mining stocks really get hammered, especially the junior mining stocks. And we put out a piece, we called it "Blood in the Streets," and people might have thought, oh, it's time to buy stocks because there's blood in the streets. No, it was time to buy gold stocks because there was blood in the streets. And look at what how the gold mining industry has outperformed. It's been the leading performing industry since those in the whole stock market since those March lows, and it's still cheap. But you can also look back to 1929, for instance, and 1930 when we had that first leg of you had the October stock market crash, and then we had this 4-5 month relief rally. Back then, I wasn't alive, but it was. Go look at your charts, and you can see that in the Dow Jones and the S&P, they rose into early April of 1930, and similar perhaps type of a length of time that we've seen this relief rally after that first down leg of the market today. And but from that point forward, the Dow and the S&P proceeded to plunge another 80+%. I'm not kidding. Go look at your charts. At the same time, you can look at Homestake Mining, the biggest gold miner of the time, and you can see how that stock, while it came down during that October crash, it at the same time as the market was proceeding down 80%, Homestake Mining proceeded to increase something like sevenfold. I'm not kidding. So this is the type of opportunity and setup that I think we have today for gold mining stocks and the rest of the stock market to really diverge in a big way here.
Okay, that I think giving a lot of people hope there, Kevin. But before we wrap up, can you let our listeners know more about your work at Crescat Capital?
Thank you. Yes, at Crescat, we are a global macro-oriented asset management firm, and we have 5 strategies. We've got two hedge funds, a global macro fund, a long-short equity fund. We've got 2 separately managed account strategies, one that's been around for over 20 years, which is a large cap equity strategy. We have a precious metals separately managed account strategy that we launched a little bit more than a year ago. It has really been starting off strong out of the gate here. We've got great long-term performance across all these products, and I encourage you to check out our website. But the one that I'd really like people to focus on today is our new precious metals fund that we're launching, and it's an activist-oriented fund that given where we think we are in the precious metal cycle, we are investing in an overweight in the junior exploration side of the sector, and we're partnering with an exploration geologist who is world renowned. His name's Quentin Henney. We're going to be we are going to be doing a series of videos about the companies that we're investing in along with Quentin. We've already started that, and I encourage you to check it out. But our new precious metals fund will have a more activist-oriented approach to it than just our SMA accounts, and we'll be able to participate in private placements that offer warrants and additional upside and anti-dilution measures in the companies that we're investing in, which gives it a little bit of an edge over the SMA account. But the SMA account, we're really excited about that too on the precious metals front. That's available at much smaller minimums, and for non-accredited investors, we're not about just trying to help the 1% here. We want everybody to be able to participate in this gold bull market, and we want to help them. And we also have this really exciting new private fund for folks too who want to get involved with that. So that's what's going on here.
Kevin Smith, we appreciate the time you've given us, and we hope you have a good week ahead.
All right. Thank you, Patrick.
Thank you also, Kevin. That was Kevin Smith, founder and CEO of Crescat Capital. For more of his insights on the global economy, please visit www.crescat.net. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content, and do also check out the SBTV podcast on iTunes and Spotify.